Hello and welcome to the Adansonia Capital Global Opportunities Portfolio Update for June 2026. This is our disclaimer. Please read it at your leisure. To move forward, I will take it as read. So for the month of June, the portfolio returned just under 1%, 0.9% versus the market as we define it, 3% underperforming for the month around 2%. The reason for this I'll talk about in the ensuing few slides, but we have significantly reduced our exposure to the market through June. For the June quarter, we essentially delivered a market return of 13.3%. So as I mentioned previously, we've reduced our exposure to the market over the month of June, and we've increased by increasing our portfolio cash to around 45%. So why have we done this? I talk about this in the next two slides, but first and foremost, the market is pricing a lower risk world. At the moment, we've got most equity indices at or near record highs, and we've seen renewed tensions in the Middle East between Iran and the US, and it's very hard to see a situation where these tensions are going to basically end in the near term. And in a manner that will be tidy, I guess. Oil prices have basically bounced up as high as $100 a barrel. They're now off a little bit with a small break in tensions, but again, we don't believe that this quiet period will last. Also, bond yields have been increasing. The U.S. Treasury yield has rallied with oil prices, and it's signaling at least one tightening by the U.S. Federal Reserve, which is not consensus. In actual fact, it's a little bit over one, about 1.25 tightenings. It's not consensus at the moment by the market, and we'll find out in the next day or two whether or not the U.S. Federal Reserve under the new Chairman Walsh will actually tighten interest rates. This is not basically being priced in the market. It's not consensus. Also, as an observation, we've seen the U.S. yield curve has flattened. This, as I mentioned before, obviously implies more restrictive near-term policy, but also longer-term, potentially slower growth or the impact of AI deflation, where essentially, AI will essentially increase productivity and reduce inflationary pressure moving forward. Interestingly, we've also noticed that insiders, CEOs, or the C-suite have been selling shares in their own companies versus buying. This is actually a very telling indicator that we look at, and obviously not positive. We believe signaling that the market is at or near a top. The market has also moved away from pricing equity fundamentals. We're a fundamental manager, and we've been scratching our head really over the last few months. We've seen the folly that is SpaceX. Massive IPO that basically had a subscription price of $135 a share. It ran up to $225 to now collapse to, I think, around 110, 111 US a share. Also, earnings growth has stopped driving share prices. This is one of our key philosophies as a fundamental manager, and we have seen, with companies like Alphabet, Google, which just recently had a blowout result. Their shares fell 7% because capex has been a little bit higher than expected by the market. Also, in all of this, the market, we believe, still doesn't know how to properly price AI companies or software companies, and essentially, as I said, it's making it difficult for fundamental managers to basically deal with this market at the moment. Over 85% of equity flows into passive products. So again, companies are being bought by virtue of their size, not by virtue of their value. And this is being done, or this investment is being done with little to no fundamental thought. Interestingly, also the next slide also shows that the total value of all the U.S. listed equities versus the value of the U.S. economy is at 200%, or basically the value of the listed equity market is twice that of the U.S. economy, which has been a record high since this series started in 1970, which is also sending alarm bells. So What have we done? So obviously we have taken exposure out of the market. We believe the market is at or near its top, and it's due a correction. Um, so over the month of June, we raised portfolio cash to around 45% by exiting our holding in Comcast, in Intuit, in Louis Vuitton, Thermo Fisher, and Universal Music Group. And we've also reduced our holdings in Alphabet, Amazon, JP Morgan, Microsoft, and Taiwan Semiconductor Manufacturing Company. It's left us with 10 stocks and just under 45% cash. So anyway, that is the update for June 2026. As always, Tony and I are available for a chat, either through our phone numbers, which are here at the bottom right of this page, or by our emails. I will basically be chatting with Rob and having a quarterly update in the next week or so. Otherwise, I'll be back with an update for July 2026. Thank you again for your support and for your attendance to this webinar.